There is a lot of confusion about Roth accounts out there. What are the rules for distributions, contributions? Everybody is confused. Let's end it. Let's clarify what are the rules related to Roth IRA accounts. Why do we love Roth accounts? Well, they grow tax-free. The distributions from these accounts are tax-free if we follow the rules. There is no required minimum distributions, and the distributions are not included in your adjusted gross income. Distributions are also not included in any of modified adjusted gross income calculations. They don't affect your income-related monthly adjustment amount, and they do not affect your taxable Social Security, and they also do not limit any of your AGI-based deductions. And you name all these things, but distributions from those accounts, they do not affect any of those. And also, there are different calculations for different tax deductions. Follow the rules. And the first thing is, how do you get money into a Roth account? Well, there are only three ways: contributions, conversions, and gross earnings. Contributions, let's talk about them. What are the rules there? Contributions to Roth accounts must be done by April 15th of the next year. So we can make contributions for 2026 by April 15th of 2027, which is rather cool because we have more time. But limitations, the amounts which you can put into account are limited and they change every year. And the income, you have to watch out for income because you might get to the point where you cannot contribute to your Roth account. For 2026, if you are under 50, can only contribute $7,500, and for those who are 50 and older, we can contribute up to $8,600 to our Roth account directly. And what are the income limitations? First, you must have taxable income. If you don't have taxable income, you cannot contribute money to your Roth account. Second, a single person earning more than $153,000 a year in 2026 will get into gray zone, and once he or she reaches $168,000, then boom, cannot put any more money anymore. For married couples, we have a marriage penalty because it's not exactly double. It's $242,000 per household, and then once they reach $252,000, then they cannot contribute anymore. And
gross?
That's adjusted gross income. Yes. And if you're filing as married filing separately, you're toast. Because if the couple makes more than $10,000 in any given year, they're cut off. So do not file married filing separately. It's not a good thing in most cases. All right, so contributions we know have a lot of rules, limitations, amounts, income. We have to be careful, have to plan for our contributions.
Like you have with conversions.
Conversions are looser on the rules. They must be done by December 31st. There is no, like if you are doing it in April, it's going into the next year. Conversions cut off at December 31st every year. They're all taxable. The conversions are taxable events. Sometimes in rare cases, there could be places where it's tax-free, but it's very rare. Okay, income, how much was your income? Doesn't matter. Amount you are converting, doesn't matter. Your age, doesn't matter. So you can be 30 years old, you be 80 years old, you can earn $0 on $1 million. You can convert 10,000 or 10 million. Doesn't matter. The only thing is it's all taxable. You have to pay taxes. So that's what you have to keep in mind. Alright, so since the conversions have fewer rules and limitations, that's where the backdoor contributions come in. This is for people who earn more money than, let's say for a married couple, $252,000 a year, and they cannot just directly contribute to their Roth account. That's when backdoor contributions come in. Oops, I will press the wrong button. And this is a result of a loophole, so to say, because you contribute first to your traditional IRA, because there is no limitations on your income. You put this $8,600, you put the traditional IRA first, or $7,500, depending on the age. And then when you convert it to Roth IRA, that conversion could be taxable or not. Because if your contribution to traditional IRA is not taxable, then your conversion to Roth will not be taxable. So, if your contribution to traditional IRA is not tax deductible, then your conversion to Roth IRA, that's the only case where it's not taxable because you didn't get a tax benefit. But that's basically what backdoor contribution is. There is nothing magical about it. It's just an immediate conversion to Roth. Too much money and your employer doesn't offer any Roth account option as their 401k, then it makes sense. When you are self-employed, when you have a small business going on, and you don't have any retirement account version set up for yourself, that makes sense. But then let's talk. If that's the case, we need to talk. And if you don't like the 401k, which is offered by your employer, that might make sense. But other than that, that's pretty much, it sounds cool. Backdoor Roth contribution, but really it's
Sounds almost kinky.
Yeah, sounds almost kinky, but really it's used really rarely. So, how do we spend the money from the Roth account? There are rules. If you want it to be tax-free, there are rules. And first, we need to explain how the IRS views our money in a Roth account, because all we see, hopefully, is a big chunk of money in a Roth account. But the IRS sees it differently. They see contribution, and when you take money out of your Roth account, contributions always come out free first, and they're always tax and penalty free. Doesn't matter what age, doesn't matter. If you take out your contributions, they come out first. Conversions come out second, and they're subject to rules. And earnings comes out last, and they're subject to rules as well. So,
That's the biggest thing people don't get.
That's the
Your
biggest
conversions
thing.
are automatically free to take out. Contributions, excuse me.
The
are
money
immediately
which
free
you
to take out.
contributed to your Roth account is your money. It always was your money. You took this money from your Schwab account, from your checking account, savings account, you paid taxes on it. It's your money. You wrote a check or you transferred money in, you made a contribution. Conversions came from the money from another tax deferred account, 401k, IRA, whatever. That money the IRS has fingers in that money. So they want to regulate how you convert it. So you converted it to Roth. They still keep their fingers on that money. So conversions are subject to rules, and that's where Roth clock comes in. It's very confusing, and it only applies to conversions and earnings, not contributions. Conversions and earnings. And there is a different set of rules for those who are under 59.5 and for those who are 59.5 or older. Two different sets. First, let's talk about people who are young, under 59.5. Every conversion you make, including that backdoor contribution, starts its own clock. And distributions from conversions are not taxable. There is no regular tax because you already paid the tax when you convert it. However, it is subject to 10% premature distribution penalty because you're under age 59.5. So when your money was in a traditional tax-deferred account, it was subject to that limitation. You couldn't touch it until you reached 59.5. So you paid taxes on the conversion. Now you want to take money out, and the IRS says, give me 10%. Still too early. I wanted you to keep this money in that account longer. So still subject to penalty. And once your conversion is 5 years old, it becomes penalty free. So even if you are 58 and your converted money is 5 years old, your conversion, that first conversion is 5 years old, there is no longer penalty. It's only for the first 5 years. All right.
No penalty, but still taxes.
No.
No taxes either?
Okay, that's if you are 59.5 or younger, if you are not 59.5 yet, and you've done a conversion, you paid the tax.
Okay.
Now you take the money out and it's too early, like before 5 year hit. So after 5 years, no taxes, no penalties, no nothing.
I see. So if I had wanted to retire before 59, I should have started my clock 5 years ago. Is
Yeah.
What you're saying?
Yeah.
To avoid the penalties.
Yes.
Got it. Okay.
All right.
And each conversion has its own clock.
Multiple conversions
Yeah.
equals multiple clocks.
So you have
Perfect
to have
timing.
kind of a plan of when you can do
Who keeps track of conversions? The custodian is supposed to keep the track of your conversions. Do they do that? We hope so. But we recommend that you keep some kind of track of your conversion, a conversion diary, a spreadsheet, or something. So you have some kind of idea when you converted which money, so you can compare it to what your custodian has once you take the money out, because you might need the money, right? Before it's 5 years old. Okay, so what for those who are 59.5 or older, all clocks go away. Once you hit 59.5, all clocks go away except for one. Your very first Roth IRA. If that account is at least 5 years old, all your conversions, all your money becomes 5 years old. So you don't have to worry about this process anymore. Only one clock matters, the first one. And earnings, ooh, that's the biggest thing. For earnings to be tax and penalty free, both boxes need to be checked off. You must be 59.5, and your very first Roth IRA has to be at least 5 years old. And the answer is the 401k world doesn't talk to the IRA world. And let me explain an example. Let's say you have an old, teeny, puny, tiny Roth IRA account and big, fat, Roth 401k which is 2 years old. You converted something, You got lucky with the investments, they multiplied, so now you have big gross 401k, which you converted $100,000, and now it's $1 million, but it's only 2 years old. And any tiny Roth IRA account 20 years old. So, and you say, okay, I'm about to turn 60, I want to buy a Ferrari for my 60th birthday, I want to take $350,000 from my Roth 401k and buy that Ferrari. Can you do that? Yeah, you can.
Penalty.
There will be no penalties. You are 59 and a half, you are turning 60. But the first $100,000, your original conversion, you pay taxes on it, will be tax-free. But $250,000 will be completely taxable as ordinary income because it's earnings. So, but you don't want to wait 3 more years for the account to be 5 years old. You want that car, right? That's what you do. You take your Roth 401k, you convert it to Roth IRA. Now your Roth 401k becomes IRA. Now this is the world where they are talking. Now you are 59 and a half, and your very first account is at least 5 years old. So now you can take this $350,000 and go and buy that Ferrari, penalty and tax-free.
Not a taxable event.
Not a taxable event. However, I strongly recommend not to do that because if you want the damn Ferrari, just rent it, get it out of your system because 2 years from now you'll be selling it anyway. So, now, how do we count the time? IRS has different calendar. They view calendar differently. IRS's calendar is based on tax years, not calendar years. So, it's very cool actually. On December 31st, every year, you get 1 year. Let's say you opened your Roth account or converted your account on December 30th. On December 31st, even it's 1 year, just 1 day, you get 1 year. Cooler still, if you make a contribution on April of 2027, April 15th, 2027, you make a contribution to your Roth account for 2026, you get 1 year. In 2027, you have 1 year for the whole year in 2026, and then on December 31st, you get another year. So you get 2 years in one. Pretty cool, because it's based on tax years. So how do we keep it all straight? Our simple advice to keep it simple, open your first IRA account as soon as possible. As soon as you can. Contribute or convert to that account as much as soon as you can. And just don't mess with it until you're 59 and a half as possible. Your retirement accounts were designed not to be touched until you're 59 and a half, so leave it alone. So, why do heirs love Roth accounts? We love Roth accounts. Why do heirs love Roth accounts?
No tax.
No tax. The distributions are tax-free. They don't pay the tax-free growth. No required minimum distributions. They have to take money out of that Roth account in 10 years. IRA account, they didn't touch it. They rolled it over to portfolio medics. In 10 years, it's $20 million, or whatever it is. They have to zero it out. They have to move it to a regular account, but it is still tax-free. They love it. Which phone call would you rather receive from your financial advisor? Mr. and Mrs. Ayers, your mother passed away and she left you $2 million. And now it's subject to required minimum distributions, and it is based on your mother's age, so you have to take it faster in bigger chunks. So you are pushed to a higher tax bracket. Now you are in 37%. We suggest you postpone your conversions we planned, because now we have to deal with the taxes you have to pay on required minimum distributions from your mother's IRA. Or Mr. and Mrs. Ayers, you received $2 million from your mother's Roth IRA. What do you want to do with the money?
Have fun.
Give it all to me.
Which phone call is better? So, but side note, When you die, your Roth account will be included in gross estate. So if you are cruising over $15 million, plan, let's talk, need to plan. And other than that, let's party.